Let's also bring on board Krishna Kumar Karwa, MD and CFO at Emkay Global Financial Services, to talk about his thoughts on the markets. KK, hi, morning. What's the market mood like at 6,200? Currency eased off and good amount of liquidity as well flowing in.
Yeah, market seems to be gung-ho, and 6,200 is a very important psychological level. But yes, FII flows have been positive, and even the results season so far, numbers have been broadly along expected lines. So expectations are building up that hopefully this time around we'll be able to decisively move beyond 6,200, and hopefully the rally will become more broad-based. That's the need of the hour, because so far we have not seen any great participation from the mid-cap segment, and that's where a majority of Indian investors are invested in. So the expectations are building up that hopefully the risk appetite will move to the large mid-caps.
KK, historically every time markets have gone up on liquidity, the end game is always very dangerous. This time around also markets have only gone up because of global liquidity. Do you think it's a matter of time we will get a poor economic headline, some bad news, and which will really change the market trend?
Yes, there is this, what you say exactly, I mean that's the way always it has panned out. But having said that, this time around if you look at the domestic economic policy announcements or etc., those things seems to be more constructive and more positive. As far as poor numbers or poor announcement, I mean that is kind of discounted in terms of the situation as far as the GDP etc. is concerned. So yes, there could be some hiccups here and there, but the sentiment seems to be very positive, and the FII flows seems to be robust, and there doesn't seem to be any global event, at least for the next few months, which should hamper this robust inflows. And also please understand that your currency now is stable at around 61, 62 levels, and you have an RBI governor who's loved by the international fund managers. So these are the important factors which will keep FII investors to be positive about India currently.
KK, whereas IT stocks or IT companies are still in a demanding and a commanding position, the cyclical end of the market is looking strong. Banks have made a roaring comeback. Banks fell because of NPA and credit growth concerns. Those concerns still exist, but banks are up by 25 to 30% from the recent low.
As far as banks are concerned, if you look at the numbers which came about in the last quarter, some of these banks have come out with numbers as per expectations, and even if you look at the way they have corrected, and the holdings of most of the funds have come up, and if you believe that there is an uptick which is expected to happen in the economy in the second half etc., then banks offer you a great opportunity to play that sector. IT stocks you were mentioning about, IT has done well, and it will probably consolidate at these levels before making the next move. But banking and financial services is a sector where FIIs love that sector, and post the numbers which have been more as per expectations and not given disappointment, probably you will see more follow-up buying coming from FIIs into that segment, and more so it will be in the new generation private banks and maybe some of the old generation private banks where the numbers have been positive. As far as public sector banks are concerned, valuations seem to be attractive, but still the numbers are not out, and issues on NPAs etc. seem to be, investors will wait to see how NPAs pan out and then probably take a call on that segment.
KK, now that most of the IT frontline earnings have actually come out, what have you made of the run-up in the entire sector, which we've seen from the last quarter to now, and the profit taking that we've been seeing off late? Does it seem like valuations are now hitting the roof and perhaps these stocks may ease off in the near term?
I think the whole IT sector is in the midst of a bull run, and what we are seeing currently is more of a kind of a consolidation post the sharp run-up of the last quarter, and numbers broadly have been as per expectations or maybe slightly better. So I would say that it's more of a breather, and it is an opportunity for investors who have probably missed the first part of the move to add to their portfolio. and it's across the board, whether it's the large cap IT companies or even the top-notch mid-market IT companies. They still offer you good opportunity for investing and making decent appreciation in the next 12 to 24 months. There are positive tailwinds as far as the business itself is concerned, and currency being where it is, there will be some positive rub-off from there also.
KK, I'm not sounding bearish, but I'm simply surprised with the market complacency. There is global liquidity. Can we afford to ignore the basic core fundamentals?
It's always a challenge doing the right balance between liquidity and domestic fundamentals. So you're right when you say that currently markets are ignoring domestic fundamentals to some extent, and respecting liquidity. But if you look at the markets per se, there is only some 40-50 stocks where you see robust FII inflows and whereby the markets are where they are. But the broad market is still at a 3-year 28-30% kind of lows versus 3 years ago. So still the broad market isn't reflecting, and that's where the reality is in terms of the domestic fundamentals. So within the NIFTY itself, if you see, there are a few sectors which have done very well over the last 12 to 18 months, but some of these sectors have underperformed, and rightly so. So I think we should respect liquidity, but finally it's always about valuations.
So where are you seeing the pockets of strength emerge, KK? Because we've seen the outperforming sectors like IT, like we just talked about, easing off a wee bit. What could actually fuel further rally into the markets?
As you earlier asked also, I think the rally has to continue further. Then your banking and financial services sector, that should further move up. They are around 20% kind of weightage in the NIFTY also, and valuations are not exactly very expensive. So if your markets have to move up further, then that's a segment which should rally further. Then in the oil and gas sector, again, there could be some positive moves in stocks like Reliance, etc. They have done decent numbers, and it's an index heavyweight with around 8% kind of weightage. So if that stock continues to perform the way it has performed in the last few weeks, then that could help the index to move to the next level. But more than that, I would say that for the markets to feel more comfortable, I think it's more important that the rally becomes more broad-based, where you should see more participation from the large mid-caps as such.
You just talked about Reliance. It's had a good run-up post its earnings, and of course, or rather takeaways coming in from Dudley and Mr. Ambani's meeting as well. Do you think Reliance at the current level becomes a buy?
I mean, we are positive on the stock, and we believe that in the next fewer time frame, it should give decent returns. I mean, currently maybe the gas issues, etc., and also whatever investment they have made in the last few years, everything should start delivering returns in the next 2 years. So we believe that this is a stock which which should give decent returns in the next 12 to 24 months.
Okay, so what should one buy into cyclicals, especially banks? PSU banks which offer deep value, but for them NPA concerns will never go away, or one should only focus on the private banking space where quality of earnings and the underlying asset is much better than the PSU banks?
I think first of the block will be obviously be the new generation private banks, because that's where the certainty of earnings, etc., seems to be much better, and that's where you'll probably see the FII flow continue. But having said that, some of the large public sector banks also offer you deep value. So a right mix would be maybe an overweight on the private banks and maybe taking small positions in the public sector banks. But public sector banks, they have their challenges in terms of their capital adequacy as well as ability to grow their loan books, etc. So they will possibly underperform in the beginning, and then maybe over a period of time they will deliver returns.
So give us 3 names that you like from the banking pack, AK, both from private as well as PSU combined.
We believe that ICICI Bank, Axis Bank and Federal Bank amongst the private banks should deliver decent returns in the time to come. These are the banks that we prefer amongst the public banks, amongst the private sector banks. And as far as public sector banks are concerned, I believe that State Bank of India and Bank of Baroda should be the ones which should be looked into.
In fact, talking about Federal Bank, it's gained for a third day on the trot. It's crossed its 200 DMA as well and has seen the best percentage gain since the 5th of September. There you go. In the last 7 days itself, it's charted a good 32% in the green. And let's see the intraday chart as well for Federal Bank. In an otherwise tempered market, Federal Bank is holding high by, well, almost 8.25% move.
Yeah,
there.
and some of the Singapore guys are really buying very aggressively into Federal Bank, and the logic here is that look, it's a cheap bank, the new management has done all the right things, NPA is not a huge concern, and this is one bank which will benefit because of the NRI remittances and because of that FCNR deposit. They put a very strong franchise network in Kerala, and that's where a lot of land share of the NRI remittances will happen from Gulf. So 77 almost 78 now for Federal Bank. KK, I'm tempted to ask a follow-up question on Federal Bank. What is so unique about this bank?
Yeah, you rightly said that there has been this management which is in there for some time now, and they are running the bank as a new generation private bank. And second thing is, as far as their NPAs etc. are concerned, there have been positive as far as the additional NPAs and the restructured assets are concerned. So all this and the valuations itself, but despite all features of a new generation private bank, but still it is available at less than one-time price to book FY15. So it's a unique combination which is available to you.
KK, final question on the mid-cap space. You are quite constructive on the mid-cap space, but as of now the market construct is that only large-cap stocks are doing well. And the reason why large cap stocks are doing well is because of global liquidity. So whereas the deep value argument for mid cap is very valid, but it may not work in the short term.
Absolutely, I agree with you as far as your thought process is concerned that mid caps may not deliver in the immediate. But the point is that you have to finally take a call from a 12 to 24 month perspective. And if you believe that things will improve in the second half of the year and going forward, then today is the time for you to buy into the large mid-caps which probably are available at reasonable valuations. And again, mid-caps are not you have to be very, very granular and bottoms up in mid-cap stocks and buy into them accordingly. Value is a misnomer because what is important is management, business abilities, etc., business prospects, and the kind of enterprise value that many of these mid-caps have. So you'll have to be very careful into what kind of mid-caps you are choosing, but there is an appetite and there is a lot of interest in mid-caps is what I'm saying.
KK, always good chatting with you. Good to have you on board with us. That's the call coming in from Krishna Kumar Karwa from Emkay Global.